Welcome back to our quarterly Macro Insights conversation. Good day, everyone, and thank you for joining us. I am Tshiamo Masike, economist at Momentum Group. At the start of the year, we framed 2026 as a year of cautious optimism. We were expecting easing inflation, lower interest rates, and a gradual recovery in global growth. 5 months into the year, and the landscape is a lot more uncertain, with more downside risks emerging. A key shift has been escalating geopolitical tensions, particularly in the Middle East. As a result, financial markets are recalibrating expectations around inflation, interest rates, and economic growth dynamics. So in today's discussion, we will revisit some of the key themes we highlighted earlier this year, unpack what's changed, and more importantly, what it all means for the global outlook and for South Africa. To help us unpack these shifts and impact is Sanisha Packirisamy, Group Economist at Momentum Group. Sanisha, thank you very much for joining us. I want us to start with geopolitics, which has been front of mind for markets. We've seen events like the short-lived operation in Venezuela from the United States, and we also saw the US-Israel attack on Iran. And both these events actually had different implications for the global outlook. The latter, in particular, has put much pressure on energy markets for fertilizers and commodities like aluminium. Can you unpack the main transmission channels? How do disruptions in one region filter through to global prices and supply chains more broadly?
Thank you, Tshiamo. It's lovely to be here. Well, the Iranian conflict happened in phases. And so the first domino to drop was essentially the oil price and the price of natural gas. And that's because a fifth of those commodities transit through the Strait of Hormuz. The second domino to then fall over was essentially the risk aspect. And so we saw that, for example, container shipping costs went up by about 20%. And if we look at insurance costs, maritime insurance at its peak, in some cases, went up ninefold. And then the third domino to drop was really your upstream and your downstream industries. So as you make mention of fertilizer prices going up, and that's because of the components transiting through the Strait of Hormuz, agriculture becomes a weak point in the economic trajectory. With agriculture, also very reliant on logistics costs. Over in manufacturing, items as far-flung as things like plastics and paint have also seen prices going up. And so we've seen a number of auto manufacturers also complaining about rising input costs, and this can trickle over into consumer-related goods. Now, I do think that in the longer term, we are likely to see an overhang in the economic shadow coming through from the Iranian conflict, given that quite a big chunk of supply came out of the market. In particular, I do think we're going to see a reconfiguration of global supply chains coming through. And the second is quite concerning because we were of the opinion that the Middle East would come about with one singular approach. Now we are likely to see more geo-economic fragmentation even in that area. And one of the clues here was essentially the United Arab Emirates stepping out of OPEC.
You mentioned the potential long-term economic shadows of the war, and I think that's interesting because coming into 2026, the expectation was that the global economy will actually continue to be resilient, and the general environment was quite supportive of that. So we had recession risks that were low, inflation was easing, financial conditions were stable until geopolitical tensions started to rise. So how have these geopolitical developments actually shaped our economic growth outlook?
Well, generally, it's going to make it a lot weaker. And so we look to the International Monetary Fund's latest World Economic Outlook update that they produced in April. And they ran a number of scenarios. Now, quite testament to the high level of volatility, they didn't call it the baseline scenario, but rather the reference forecast, in which energy prices are about 20% higher. And it's in that kind of environment that we get global growth averaging just over 3% for 2026. Now, that's broadly speaking just slightly lower than what we've seen on the longer term average. They also run an adverse scenario in which we get a slight energy dislocation in markets. And so that has a pricing impact and a supply impact that comes through. And it's in that kind of environment that global growth averages around 2.5% for 2026. And then they run a more severe scenario And it's really in that scenario where that energy dislocation in pricing and supply persists for much longer, even going into 2027. And the growth outcome here on average for the global economy for this year sits at about 2% and remains quite low going into 2027. And so that tells us that there would be some economies that are really teetering on the brink of a recession in that kind of world. Now, there are some economic winners and losers from the war. The big ultimate loser is going to be your Gulf nations. Yes, they do get the pricing impact coming through, but they also get knocked on the volume impact. Tourism flows decline, infrastructure is degraded, and risk sentiment toward that region remains quite negative. Other economic losers in this kind of environment, Europe and Asia. In Asia, we've got nations like India that are a net importer of oil from that region, and so they get heavily impacted. And if we look over to Europe, it's really your very industrialized nations such as Germany that still rely a lot on oil-related products. If we think about the United Kingdom, they came out of quite a soft growth period in 2025, and a lot of that soft overhang is going to persist into 2026. And according to the IMF, out of all the G7 economies, they had the biggest downgrade applied. Very little fiscal headroom to maneuver there as well, and 80% of households are still reliant on gas for heating purposes. And then we get some economic winners, and these are predominantly the countries that can export oil-related products that are a bit further away from the epicenter of the conflict. So yeah, I'm thinking about Canada, Norway, parts of Latin America. Russia is expected to see an increase in their government revenues of about 100 billion US dollars this year, and that's because sanctions were lowered. And if we look at the US, even though the consumer is negatively impacted and the fiscal dynamics because of more defense spending, the US has now become the #1 exporter of hydrocarbons. So quite a fragmented, diversified view in terms of where growth is headed.
So what I'm hearing is that the duration of the conflict, plus the country's dependence on energy, is going to be key elements for the growth outlook of these countries. Let's now move to inflation. So how have geopolitical developments changed the inflation outlook from what we were expecting at the start of the year?
Well, at the start of the year, it was looking as though disinflation was entrenched. So still positive inflation, but falling inflation over that period. However, we've now had this big exogenous factor coming in, which is the oil price. So again, turning to the International Monetary Fund's analysis and the scenarios that they've run, in that reference scenario, global inflation is expected to be at about 4%. Now, this is taking into account that you don't really have a lot of spillover effect. In the more adverse scenario, those underlying inflation risks start to pick up, so core inflation becomes more of an issue, and the global average for inflation year is about 5.4%.
Okay.
And then in the more severe scenario, this is really when wages start to pick up. Price-setting behavior reacts to the Iranian conflict, and so you get more entrenched second-round inflationary impacts. The average headline inflation for the global economy above 6% for this year and remaining high into 2027. So ultimately, it will depend a lot on whether the country is a net oil importer, whether they're running a current account deficit, how has the currency fared in this environment, and whether or not inflation expectations have become de-anchored during the Iranian conflict. Ultimately, it also depends a lot on how quickly lost production can come back into the system. So according to Goldman Sachs, it would take about 70% of that production can come back on stream within a period of 3 months if the Strait of Hormuz is fully open. But there is a bit of a tail-end distribution there, so it will take 6 months for us to get to 88%.
Sure.
So what that does tell us is that there is some infrastructure that has been permanently damaged, but not necessarily affecting the bulk of that oil supply.
Okay. The heightened inflation concerns have also contributed to tighter financial conditions, which in turn have revived worries around an AI-related bubble, particularly given the debt dependence of many smaller non-listed AI firms. How are major central banks responding to these concerns?
Well, I think, at the start of the year, global central banks were quite comfortable about the pace of disinflation, almost allowing them to cut interest rates further. However, this has been turned on its head now with renewed inflationary pressures, and central banks are taking a far more wait-and-see, cautious approach and being very data-dependent. So when we look at the US Federal Reserve, markets were anticipating that they could potentially cut by 2 or 3 times this year. However, they're now expecting a slight hike by the end of the year as conditions have now turned unfavorably. The Federal Reserves themselves have warned about risks to their dual mandate and have upgraded some of their inflation forecasts. A crossover in the Eurozone, we've seen that the European Central Bank are now warning about risks of stagflation, which is lower growth outcomes and higher inflationary outcomes. Now, at the start of the year, the market thought that the ECB didn't really have to do much on interest rate policy, given that inflationary pressures were at bay. Now, with renewed inflationary pressures, the market's actually pricing in 3 interest rate hikes. But again, with the ECB signaling stagflationary risks, we do also worry about the growth impact, and we think that 3 interest rate hikes is a bit aggressive. And in a very similar vein, if you had to look at the United Kingdom with the Bank of England, they were already struggling with very high elevated services inflation even before the Iranian conflict took place. And so while the market was anticipating between 1 and 2 interest rate cuts at the start of the year, the market is now looking to 2 interest rate hikes by the end of the year. But given that they have to start pulling in on the fiscal side, further monetary policy tightening could be very negative for the growth outcome. And again, here we see 2 interest rate hikes has been a bit aggressive.
So it seems like the market expectations can be a bit excessive, but generally the theme of higher interest rates for longer seems to be back. Then moving on to the fiscal side, the IMF has warned that these rising geopolitical tensions are adding fiscal pressures globally, which is forcing governments to make tougher trade-offs between security, debt sustainability, and essential public spending. How significant are these fiscal risks?
So with the geopolitical fragmentation, we have seen a reorientation of fiscal priorities. And this is why we've seen governments stepping up on the defense spending as a share of GDP. And then with the latest Iranian conflict, this is added to fiscal demands. And what we've seen coming out from governments this time around was a higher level of pass-through to consumers and businesses relative to the 2022 oil-related crisis that resulted from Russia invading Ukraine. And I think this is because governments are sitting on a much higher debt pile and have far less wiggle room on the fiscal side. Now, if we look at a report from Allianz, they've actually determined that emerging markets have spent up to 0.2% of GDP on fuel-related direct subsidies, and the similar number for developed markets is sitting at 0.15%. Of course, it does depend on the economy itself. Some are spending a bit more, especially if they are net oil importers. Now, to try and offset and address the issue of supply, we also have some demand measures that have been instituted, and half of the emerging market composite have done things like rationing fuel, trying to use strategic reserves, and even things like number plate rotation in a number of countries.
Okay. Let's shift to US politics and trade policy. Even before the recent geopolitical tensions and the negative impact that it had on gasoline prices, we were seeing signs that tariff-related inflation concerns were weighing on President Donald Trump's popularity. More recently, we saw major court rulings regarding these tariffs, and the first of which was the Supreme Court, which was striking down reciprocal tariffs which were implemented under the International Emergency Economic Powers Act. And then more recently, the Court of International Trade ruled that Section 122 tariffs, which were actually introduced as a replacement to reciprocal tariffs, were also unlawful. How significant are these court rulings for the direction of US policy? But also more broadly, to what extent could trade policy and its potential inflationary impact shape the political landscape as the United States heads towards the midterm elections in November?
Well, Tshiamo, I think there's a lesson to be learned here that trade policy can't be unilaterally changed without any kind of legal implication. That said, there are still a number of options that the US administration can take, and so I don't think that protectionist policies are dead. And as you mentioned, although consumers didn't believe it at first, there is a bit of an inflationary impact coming through on the tariff side of things. With the Iranian conflict, we've seen that Trump's popularity has fallen even further. Now, typically, you tend to get a bit of a rally around the flag impact that happens around the popularity of the presiding president. But we also know that this was a war of choice, and most American citizens were not actually in favor of the Iranian conflict. And the longer that the conflict dragged on, we saw that Trump's popularity fell even further.
Yeah.
So going into the midterm elections, it's going to be quite interesting to see whether that Republican support fractures even more. And I think it's going to be quite difficult for the Republicans to hold both houses of Congress.
Hmm. But we know that geopolitical tensions didn't just shift growth and inflation expectations, but also how markets are pricing key assets. We saw shifts in the United States dollar, movement in gold prices, but also a broader increase in perceived financial market risk. How should we think about these market reactions? But importantly, how should we distinguish between short-term movements and the longer-term structural view?
Well, markets reacted in a typical risk-off lens, as they should. The only atypical response really came through from the asset class being gold. So typically you would expect gold to rally on the back of it being an inflation hedge, but we actually saw gold dipping initially in the conflict. This doesn't, however, derail our thinking around the medium-term story, where we do still see a structural underpinning for gold as emerging market central banks continue to diversify away from US-based assets as they continue to need an inflation hedge and a hedge against geopolitical risks that are still firmly embedded in the global economy. Where we did see a very typical response was on the US currency, the dollar, which strengthened given that it is a liquidity anchor, and we saw government bond yields also selling off. Now again, with the US dollar, we had the short-term strength, but again, not derailing our medium-term thesis that we will continue to see US dollar weakness over time as investors become very concerned about the fiscal deficit and high debt levels in the US and the credibility issues of the US institutions.
So the longer-term structural view remains intact. Turning to South Africa, the global developments have risen concerns around fuel prices and inflation risks. And we also saw the SARB's tone shift to being more hawkish. Can you unpack the inflation risks that are driving this change in stance from the SARB?
So very similar to what we're seeing in the global landscape, inflation was continuing to get low in South Africa over the course of last year and into the beginning of this year. However, we have now had this exogenous impact of the oil price kicking in. And so central banks in South Africa as well now has to take a look at how second round inflationary impacts can evolve from here. Now, the direct impact is, of course, through the oil price. And fortunately for South Africa, where we get our crude oil has shifted in the last while. So we get quite a big chunk from places like Angola or Nigeria. And so that does reduce the direct risk. However, our refining capacity in South Africa has either been mothballed, there are some delays in bringing refinery capacity back online. And so with that in order, we're actually getting in a lot of refined product from other countries, predominantly from the East. However, a lot of what comes in from the East, the underlying product is still coming through from the Strait of Hormuz. So we can't really get away from the problems in that area. Now, when we look at transportation costs, it really differs across the income earning spectrum. So when we look at the top 20% of spenders in South Africa, about 9% of their wallet share goes towards running costs for their vehicle. So that would be fuel related or maintenance related. For the rest of the basket, between 4.5% and 6% of wallet share goes towards public transport costs, which we know are very sticky on the way down. Now, I think the real problem is if we have that coming into the agricultural space and food prices start to pick up on the back of logistic costs being a lot higher. Because in South Africa, the lowest 30% of spenders, about 30% of their wallet share is going towards food costs. And so here, the central bank in South Africa has to be very attuned to how inflationary pressures go into wage price pressures and price setting behavior. And in order for them to maintain credibility of protecting that 3% inflation target, they may actually have to consider raising interest rates.
So monetary policy could respond to this by higher interest rates. But we do know that the government has stepped in and they reduced the general fuel levy by 3 Rand to try and cushion consumers and businesses from this shock. Now, with that in mind, how would you assess South Africa's fiscal position? And do you think South African government still has room to be able to absorb some more external shocks?
Well, let's give credit where it's due. And so, I think National Treasury has done quite a good job of trying to secure a primary budget surplus in the last while. However, debt is still high, so we're not in a completely comfortable fiscal position. And in order for us to secure a higher credit rating over time, we do need to support that fiscal anchor together with continued structural reforms in order to secure that economic anchor. Now, if we look at what government is planning to spend on fuel-related subsidies up until the end of June, it comes to about 17.2 billion, which I think National Treasury can stomach, given that we have had an overrun in some of the revenue streams.
Okay.
However, in the longer term, we need to become more insulated against global shocks that can affect exogenous factors like the oil price or even food prices. So in this instance, it means reforms in the economy, such as ensuring that public transport is available to the majority of our citizens and is safe and reliable, to ensure that more freight can actually move away from road onto rail, and maybe even thinking about things about restructuring the road accident fund and its levy as an example.
Okay, lastly, let's turn to South Africa and our economic growth. We do know that the prospects of South Africa's economic growth have actually weakened since the start of the year. And we are starting to now see a rise in political uncertainty, and this could further weigh on economic growth prospects. The local government elections, set for 4 November, are adding some uncertainty against the backdrop of ongoing pressures around governance, service delivery, constrained fiscal space, and infrastructure challenges such as water provision. Furthermore, the recent Constitutional Court ruling regarding Phala has actually reopened the path for a public impeachment process against President Cyril Ramaphosa. This rising political uncertainty could actually deter much needed fixed investment, which is quite important for South Africa's growth on a longer term basis. But we do know that much of the pressure comes from the global side. So can you unpack how these developments are actually shaping South Africa's economic growth outlook?
So I think there's two main channels that South Africa gets impacted by. The first is the financial mechanism. And so when we have tighter financial conditions globally, those tend to infiltrate into our local environment. And the second angle is the real economy. So when oil prices shot up, we had a negative impact on our terms of trade, as an example. And also the demand for our exports goes down because global demand is expected to be a lot softer. But even locally, we were banking on quite a big recovery coming through on real wage gains for consumers. But a lot of that purchasing power gets wiped out by higher oil prices. And similarly, on the investment side, as you point out, businesses tend to defer projects when there's a high level of instability politically domestically, but also in terms of the global economic landscape. But not to get too negative, because I do think that the recovery is merely just delayed rather than derailed. We are still very optimistic about some of the structural reforms that are happening in the areas of energy and logistics in particular.
Sanisha, that was a very interesting discussion. In conclusion, geopolitical developments are increasingly shaping not just commodity markets, but also growth dynamics, inflation trajectories, and central banks' reaction across major economies. Importantly, the transmission is not uniform, with different regions expected to experience different outcomes depending on energy dependence and fiscal space. For South Africa, these global forces matter a lot through higher price pressures, tighter financial conditions, and weaker global demand, all of which weigh on growth and inflation alongside local structural constraints. A key theme that comes through, though, is that while these shocks may disrupt the near-term outlook, the longer-term recovery remains intact. So it's more about delay than derailment. Thank you for your insights, Sanisha.
Thank you so much, Tshiamo.
Thank you for being with us today. Until next time.